Thanks for joining us today on The Close. I'm Marilla Fernandez. Markets close in 30 minutes. Let's get to the stories we are following in the BNN Bloomberg newsroom. Tim Cook stepping down as Apple CEO after 15 years. John Chernis is going to be the next CEO. The hardware chief will take office September 1st as Cook shifts to the role of executive chairman. Chernis has spent 25 years focused on product development at Apple and has served as head of hardware engineering since 2021. Northrop Grumman maintained its full-year sales forecast, missing estimates. Sales for mission systems and space systems in the first quarter came in below expectation. Now, on the upside, first quarter sales came in slightly above estimates. The American aerospace company citing unprecedented global demand with a backlog of $96 billion US dollars. Shares of Docebo are on the rise today. The small-cap Canadian software maker has been pummeled over the past year, but is getting a boost after releasing preliminary results and raising its outlook for sales and profit. The company says it's seeing strong demand for its AI-enabled workforce readiness platform, pushing against concerns that artificial intelligence will disrupt its business. Let's have a look at the TSX, which is down over 1% so far of the day, a drop of 371 points so far to 33,983. Moving south of the border, not a material move for the S&P 500. It's down just about 7 points. The Dow Jones, a 68-point drop on the day, so 0.14. And the NASDAQ moving up only 2 points, so not a big move for either the S&P or the NASDAQ today. So a bit of a mix in the North American markets, mostly in the red, as we tick down to the end of the ceasefire agreement with Iran. Let's go to Colin White, he's CEO of Verican Capital Management, to talk some more about what's going on. Colin, thanks for joining us today.
No worries. Thanks for having me.
So you are not overweight in energy, which benefited from that conflict. Why not?
It's very difficult when you've got competing tweets or truths or whatever you want to call them going out there, and things are moving so dramatically, so quickly. There's nothing really there that we feel is investable. We think that, this is a longer term issue. We're watching, for how long oil prices stay inflated, because that's going to eventually build more fulsomely into inflation. But the short-term moves are just completely unforecastable. And so we've chosen to sit this one out. We do have a weight of energy in the portfolio because we do stay broadly diversified, but we haven't leaned into this. We haven't looked at this as an opportunity to get heavier into the energy sector for sure.
As we know, the ceasefire will expire tomorrow, unlikely so far that it will be extended. If the conflict were to end in, let's say, this week, how long would you expect prices for oil to stay elevated?
That's a great question, Marilla. You're talking with a lot of confidence that things are going to end tomorrow. I think recent history would make me a little less confident in what's going to happen next. You've seen a fundamental destruction in some of the actual infrastructure. Now, I think it's going to take a while to figure out exactly does that have a knock-on effect or not. But if there's a fundamental disruption, but it's playing into a time when global economies are slowing a little bit or a little bit soft. So it depends on where those two intersect. I don't think that this is going to be the dominant thing that's going to play out. I was asked recently whether oil is going to drift right back to $60 a barrel anytime soon. That's difficult to see, because it's going to take a while to undo some of the damage and some of the backlog that's out there. But, pretty quickly it's going to become more important what the economic signs are and how much the increased energy prices are feeding into inflation and what that does to monetary policy, because it's all connected.
Do you see the price of oil and energy in general, with Canada being a powerhouse there, as more of an advantage for the TSX or more of a negative because of impact on earnings?
Well, I think it's been an advantage for Canada. If you take a look at 2025 for sure, the size of our material sector and energy sector did us very well. But there's an increasing disconnect between the domestic economy in Canada and the struggles of the consumer with, the banks having increased loan loss provisions. And, there's a lot of signs that the individual consumer in Canada is having issues. But the TSX is going to largely be run by what's going to go on with the global energy markets as well as global materials. That really has been the dominant factor. And that's the nature of the TSX. So it's kind of difficult to parse when you have such a divergence between the TSX as a market and the Canadian economy.
Let's look to the U.S. then, and tell me if you do see some opportunity there.
An opportunity to be entertained. I mean, there's a lot of news coming out, but again, finding direction is very difficult right now. We recently had our most recent PM meeting. We decided we were super neutral. There's so many conflicting short-term indicators coming out, but largely we got markets at or near all-time highs. We have economic information that is mediocre. So there's no reason to be really optimistic, we feel here. And I think that the pace at which change is happening from sector to sector. In February, we're seeing all these micro pullbacks in different industries, and AI is rearing its head again. So AI has become popular and in vogue, and that is a spillover effect. So we've watched AI displace some of the software companies pretty aggressively at different moments in time. And some of those drops have caught our attention to take a look at, but we really haven't seen anything that was actionable. When we saw the most recent market pullback, it almost hit 10%, which is kind of where we start looking at reallocating from fixed income to equity, but it didn't quite get there all the way, and it didn't get there comfortably enough for us to pull the trigger to make a change. So we're looking for opportunities, but we haven't really seen anything that we're ready to pull a trigger on.
You mentioned that AI is back in vogue. Big tech has made a bit of a comeback more recently after being down for some time, Apple included. What's your take on Apple looking forward with a new CEO in the wings?
Well, that's fascinating, because this is a very big moment in time. This is going to be a big part of whenever they make the movie, because you've got an engineer, somebody who's been in product development for 25 years, who knows the firm very well, but he's walking into a very unstable situation. And Apple is on the record as saying that slow and steady wins the race. So they don't have any huge aggressive plans in the AI space that they're talking about publicly. And some of their competitors are lobbing huge bombs, like they're investing billions of dollars and going after it very aggressively. So it's a bit of a gambit. Like this could be the the Netflix blockbuster moment, or this could be what BlackBerry or Nokia, those inflection points where you saw the balance of power move against one of the existing dominant players. And it's with somebody who's brand new. Now, his knowledge of the company should do him very, very well, but is he the kind of risk taker that's necessary to make the right choices and be aggressive enough to again not get left behind by some of the advances that they're hoping to be making in the next little while? It's going to be a big part of the movie for sure.
Let's get to go easy before I have to let you go. A little bit of a gainer today on the TSX. It is up, but I'm wondering if you think its troubles are over and whether or not the private credit troubles in general have been laid to rest.
Oh, goodness, no. I think this is the textbook definition of a dead cat bounce. It's recovered a little bit because their most recent results are not continuing to be as terrible. But more importantly, I think this is more fuel for the fire for the stress that the consumer is under. Now, again, there's a whole bunch of different indicators you can look at, but this is not the first time that a company that is exposed to consumer debt has run into trouble. And I do think that you can draw a line from some of the struggles they're having to some of the private credit issues that are going on. We're facing, a difficult time from a liquidity perspective. And like I said, in Canada, we have a consumer that's under stress. And most recent, CPI numbers coming out in Canada are a little bit higher. Somebody said they soared. I don't think they quite soared, but 2.4%, they're a little bit higher. So I think there's more pressure on the Canadian consumer. And I think that, and even Goeasy's results are announcing that they're still expecting further write-downs, and so that the pain's not over there. But I do think that it's another really good sign that we have domestic consumer weakness, and at some point that's going to matter to the stock market. I'm just not sure when.
Colin White, good to have you, sir. Thanks for joining us today.
Thanks for having me.
When we come back, another look at the new leader-to-be for Apple and what it means for their AI strategy. Back in a moment. Apple shares sliding today after that company announced John Ternus will succeed Tim Cook as CEO. Let's get into the challenge that comes with the top job with William Kerwin, senior equity analyst at Morningstar Research. William, thanks for joining us today.
Thank you for having me.
Was Ternus the expected successor, and do you see him as the right choice?
Yes and yes. This has been a move that's been rumored for the better part of the last 6 months. It was largely expected that Ternus would succeed Cook, and this really looks to us like going back to a different type of CEO, a product-focused CEO, an engineer as CEO. Tim Cook did a phenomenal job in 15 years in charge. He 10x'd Apple's market cap and really led the company through its best ever era financially. But we think now, as we look forward into a new era of AI-powered devices, it makes sense to have a product leader and an engineer in charge, and we think Turnitz fits that bill.
Okay, so what's your take then on Apple stock sliding today on that news?
Well, I would first say that it's a pretty modest slide. It's down, 1.5%, call it, I think, when we started here today. But I think it's hard to surpass what Tim Cook has achieved. He came in 2011. He introduced numerous amazing products, including the Apple Watch, Apple Pay, a lot of services like Apple Music. And it's going to be a tough bar to meet for any incoming CEO. So we think it makes sense that there's maybe a little bit of skittishness in the market, but we see this largely as a flat move. And I would just add, Apple shares look fairly valued to us against our $260 fair value estimate.
Okay. Let's talk AI strategy. We know that has to be part of his focus here. Remind us how Apple is partnering on this and how you expect him to move that strategy forward.
Yes. So it's well known at this point that Apple has, over the past 2 years, overpromised and underdelivered in terms of its Apple Intelligence strategy. We still have yet to see the really key application that was promised at its Worldwide Developers Conference in 2024. That was a fully integrated and advanced Siri that could take actions across apps and really be an AI agent on your phone. That has not been released yet, but we think partnering with Google's Gemini models and integrating those models into the Apple Intelligence Suite will allow Apple to do just that. And we think that there's going to be an announcement of a revamped AI strategy this summer at the Worldwide Developers Conference, or WWDC 2026. And quite frankly, when we think about the timing of this announcement, we think that it indicates a certain level of high confidence from Apple that they are going to get this AI strategy right with what they released this year. I think they are putting Turnitz in place at this time, specifically because they expect this to be one of the first wins under his tenure.
Okay, that being said, you don't expect a big CapEx spend, as you're seeing from the hyperscalers, on generating its own AI product per se.
Exactly, yes. We think partnering is the right move for Apple. We don't think that their role as being a developer of these frontier models like the hyperscalers are, like Google is. We really think what Apple does best is integrating those excellent software, large language models into applications that users love and that benefit consumers. And so we like that rather than competing and building its own model, Apple is partnering with one of the frontier models on the market, Gemini, and really focusing on integrating that into its products.
Do you see the company getting into robotics at all? That seems to be sort of the next big thing.
I wouldn't say in the short to medium term here, no. We really think that this is going to continue to be a focus on devices. There have been some reports that Apple has considered working on a robotic arm in the home. But quite frankly, we think Apple is working on a lot of futuristic products all the time in its basement engineering labs in Cupertino. It was reported that they were working on a car for a while, and it seems that that has since been scrapped. I would not expect robotics here in the next 3 to 5 years. No.
Okay. They are reporting, I think it's next week. I know they had a stellar previous quarter because their latest iPhone was really popular. I'm just wondering what you expect this time around.
We expect strong year-over-year growth again this quarter. And I think something that I would hone in on here is profitability, and specifically gross margin. It's been well reported that memory prices in the market have been skyrocketing and really pressuring cost inflation on consumer devices, PCs, smartphones. What's been impressive is that in the face of these rising memory prices, Apple reported a record gross margin last quarter and guided to another record gross margin in the quarter that they'll report next Thursday. And we really credit that to supply chain management. We think Apple is able to extract the best terms from its suppliers, whether that's in memory or outside of it, to really help massage the blow of this cost inflation, if you will.
Okay, besides AI, which we discussed, do you see any other headwinds for the company?
There are always a few headwinds facing Apple, yes. If you had asked me a couple of years ago, I would have pointed to some antitrust scrutiny surrounding the payments from Google. That has been resolved in court in the US. And so those look secure for payment to be the default search engine on Apple products. We're really looking at China, and China had a phenomenal year of growth in the quarter ending in December. And so it will be interesting to see whether it executes that same growth in the March quarter that they report next week. Because China a decade ago was really a strong growth engine for Apple, but over the past few years has gone from decelerating in growth to declining in absolute sales. And so China has been a headwind of late, but they're able to repeat the pattern of last quarter. It looks like that may be inflecting to the positive.
William Kerwin, I'll leave it there, sir. Thanks for joining us today. Appreciate it.
Thank you.
Up next, the Fed chair nominee Kevin Warsh in the hot seat. We'll take a look at that when we come back. The U.S. Federal Reserve Chair nominee Kevin Warsh in the hot seat today, being questioned by the Senate Banking Committee. Trump's pick says the central bank should remain largely independent of political influence. Let's go to Blake Gwynn on this, head of U.S. rate strategy, RBC Capital Markets. Thanks for joining us today. Did you learn anything new from Warsh's answers?
I can't say I really learned too much new. A lot of the conversation was kind of focused on the independence issues. There was a lot of conversation around Warsh's finances. And at least when they touched on monetary policy topics, things that would be relevant to the market, I thought he was largely reiterating stuff that we have already heard from him. So it's a bit of a disappointment. I was kind of hoping he'd be pushed a little bit more on updates to his views, whether his views on rate cuts have changed in light of some of the events in Iran over the last month, things that we haven't been able to get from him because we haven't really heard him speak in a while. But unfortunately, it was largely repeats of things and views that we've heard from him already.
He wants to rethink how inflation gets measured. Was he clear on how he would do that, what changes he sees needed?
Yeah, I mean, look, I think everybody would love to have better inflation metrics. He mentioned this kind of billion price thing, which, there is a billion price project out there. A lot of people have come up with new measures over recent years. Even the Fed has kind of used various metrics over time, trimmed means. You've heard at various times them focusing on things like supercore, things like this. So, look, we'd all like to have better ways to measure things, and I think the Fed and BLS and others are constantly innovating on that front. I don't really think that's something particularly novel to Kevin Warsh and something that I think most economists would like to see.
Was there anything that did strike you from what you heard today that was novel or new?
I did think it was at least notable that we had a reiteration from Senator Tillis that he would not be moving forward this nomination until the issue with Piro and kind of these subpoenas that they had served over the construction project to the Fed, kind of this investigation into Powell and this building project. He kind of reiterated that he's not going to move this nomination forward until that issue is wrapped up. So there's a bit of a standoff here between the administration and the DOJ and Tillis on this front. I think maybe the administration had been hoping he would kind of back down, but he does have the power to stall this, just given the split between Democrats and Republicans on the committee. So he can hold this up, and it does look like, according to his comments today, he still intends to do so. Now, he did say he was in support of the nomination. So, once this issue is wrapped up, once they kind of the administration pulls away from this investigation into Powell, he will presumably be a yes vote. So it does look like Warsh will be eventually confirmed. It's just a matter of timing and how long it's going to take these other issues to be wrapped up to his satisfaction.
Is it likely that the DOJ will move away from that investigation?
I mean, it does seem like it has to happen at some point. I mean, he's been pretty clear on that. Now, there is a deadline on May 4th. They had 30 days to kind of file an official appeal on the quashing of the subpoenas that were served to the Fed. So it is possible that's a kind of quiet off-ramp for the administration. They could just kind of quietly not apply for that appeal, and presumably that time frame would close. And I would think that would be acceptable to Tillis to kind of continue the nomination process. process. But if they file, no telling when they're going to back away. And I will say comments from Trump, comments from Pirro, who's handling the case, it doesn't appear like there's any signs there that they're backing away.
Okay, we see Warsh also talking about shrinking the Fed's balance sheet. I'm wondering what that would look like, how that would affect, interest rates or the broader economy.
Yeah, so, we've had some great research from current sitting Fed officials over the last month or two that have gone through a real comprehensive list of ways that the Fed could try to get the balance sheet smaller. These range from very extreme, taking us back to kind of old ways of doing things, pre-crisis type of ways that the Fed used to operate, to much more smaller, marginal type of things that they could do to change the composition of their balance sheet in ways that would allow it to get down potential changes in regulation. So there's really great resources out there. There's great work that the Fed is already doing to kind of create this menu of options that could be on the table. I thought one thing that was notable from Warsh's comments today, and something that we've been arguing, looking at the analysis that we've had from these other Fed officials, is that this is going to be a very slow process. That was something that both of those papers I was mentioning have highlighted, that this is going to be very slow, very deliberate, that you need to do more work in analyzing how these different options would work, what the impact would be on the economy, on markets. And then even once a decision was made, it's likely that those would be rolled out very carefully, very slowly. So we heard Warsh kind of back that up today. So he did reiterate that he wants to see a smaller balance sheet, but did say that this is going to be a very gradual, very slow, very deliberate type of process.
You mentioned the possibility over a standoff for the charges against Jerome Powell, for the renovation. Do you see anything else perhaps holding up his nomination?
No, I think it's once that is a go. I think he has the numbers. In the hearing today, it didn't really seem like you had any Democrats who were, really moving to support, or any Republicans that were moving. But more importantly, any Republicans that were kind of wavering on their decision. It seemed pretty clear that all of the Republicans were lined up to vote for him. It was only Tillis that was holding out. So as far as we can tell, it really is only that issue. As soon as that issue is cleared up, they will almost certainly very quickly hold a vote. And I don't see any other holdups for Warsh to taking that seat.
Blake Gwynn, going to leave it there, sir. Appreciate you joining us. Blake's head of U.S. rate strategy, RBC Capital Markets. A quick look at the markets ahead of the end of the trading day. The TSX in the red today. Take a look at that drop, 1.6% down. That's 550 points plus. The S&P 500, a drop of 47 points, or 0.7%. And the NASDAQ also down, a move of 170 points on the day so far, 0.7%. We'll see how the numbers hold up for the end of the trading day in just a moment. We're back in just a second. Stay tuned. Here are the closing bells for the end of the trading day. At the NASDAQ, Progeny Inc. ringing the closing bell. Suburban Propane is in New York with the bell. You're watching the close on BNN Bloomberg. I'm Marella Fernandez. Here's how we ended the day on Bay Street and Wall Street. Day in the red for the North American markets, with the TSX down 551 points, or 1.6%, so a dismal drop on a Tuesday for the TSX. The S&P 45-point drop, or 0.6%, and the NASDAQ down about the same, 144 points down on the day. Let's get to the movers in Toronto. Going to lead here with Methanex Corporation. It is up over 5%, 5.6%, or $4.22. We're going to have more news on that in just a moment from Jeff Morgan of Bloomberg. Let's go to Superior Plus. It is a gainer today of over 3%, or 23 cents to $7.37. And then at the Basca Oil, also gaining today, it is up 3%, or 33 cents. Remember, we don't know what's going on with the conflict in Iran, meaning that ceasefire deadline is tomorrow, and it's unclear whether talks are ongoing and will produce any result. So some of your energy stocks gaining today. Gold stocks, on the other hand, we're doing this. Nova Gold down 195 or 13% on the day. G Mining also losing. It's down 11.5%. And then Orla Mining has a 10.5% drop, or $2.33 per share. All right, let's go to Jeff Morgan. He's deputy team leader for the Bloomberg News Equities team and joins us now to talk about what's going on. We had a look at gold stocks a moment. I know spot gold also down today. Give us a bigger picture of what's happening here.
Yeah, the TSX, part of the reason it had such a rough day is because of the performance of these gold mining stocks. Gold mining has quietly become the second largest sub-industry group on the TSX, now accounting for about 14% of the overall weighting of the S&P TSX Composite Index. And if you look at the top 10 decliners today, 9 of them are gold miners. So really rough day. What happened really is the U.S. dollar declined and U.S. dollar appreciated, and U.S. Treasury yields also rose. Those are two assets that compete in the portfolio, compete for space in the portfolio of investors. And so the I guess, marginal attractiveness of those other assets are rising, and these gold mining stocks are getting hit as a result. You just listed off some of the worst performers there, but there are just an awful lot of gold mining names in the TSX Composite now, and that's partly why we saw such dramatic underperformance today from the TSX compared with the S&P 500 in the United States.
Let's get to Methanex as well. I know there was some news there. Fill us in.
Yeah, Methanex, I mean, this is a stock that is clearly moving in kind of inverse with the optimism around whether or not the Iran war conflict and the ceasefire will be extended. Just a few moments ago, the Associated Press reported that J.D. Vance has called off his trip to Islamabad in Pakistan for talks to extend the ceasefire. And so this is obviously a stock that has really performed kind of in inverse with whether or not that kind of the war is heating up. Iran, it is worth noting, I pulled this stat from Bloomberg Intelligence today, exports about 9 million tons of methanol in 2025. Obviously, it's not exporting as much of that now, given the blockade, given the war. And so this is a stock that has risen and fallen kind of in proportion with what's happened with the war. In the month of March, when the war was kind of as hot as it was, this gained 18%. Now in April, it's down 4%, but it was the top performing stock in the S&P TSX Composite Index today, gaining largely because the expectations, at least for some investors right now, especially those that are betting on Methanex, is that this ceasefire, maybe the ceasefire optimism might be misplaced, at least right now.
Bloomberg Jeff Morgan with the update out of Toronto. Jeff, thanks for that. Let's get to movers south of the border. Bloomberg's Avalon Purnell joins us from there. Avalon, United Health share is getting a boost today after they beat earnings, but that stock has a long way to go to recover.
You're absolutely right. As you mentioned, United Health shares jumped nearly 7% into the close today, and that's after the insurer reported first quarter profit that completely blew past expectations, and they also boosted their full year outlook. Results from Optum Health were also in focus, as United Health said that the business performed much better than expected. JP Morgan, I think, actually had a really great note out writing that while investors will still want a better understanding of the cadence and the dynamics at play, especially for Optum, this print should definitely start off those managed care names, earnings, especially, on the right foot.
Okay, let's also get to cruise stocks. Carnival down on the day. We saw broader weakness in that sector. What's behind the move?
Absolutely. So cruise liners like Carnival and Royal Caribbean were again down as a standoff between the U.S. and Iran continues. The conflict continues to drive energy prices higher. And also, especially for cruises, the uncertainty in the region is pushing them to adjust or even cancel itineraries. Also worth noting that Bloomberg Intelligence had a great note out predicting that the fuel supply disruption could hit Carnival specifically, their 2027 net income, by nearly 36% if the Strait of Hormuz remains constrained.
Okay, let's talk about other sectors that were hit, because we have, as you mentioned, the ceasefire deadline, which happens tomorrow. We know J.D. Vance was pulled back from his trip to Pakistan. That was at least delayed. So are other signs or other sectors showing signs of reacting to what's going on?
You're absolutely correct. It's definitely a shifting situation, and traders are definitely continuing to mull what is going on with this Iran conflict. That being said, airlines were also broadly lower, and other companies sensitive to fuel costs were, as you imagine, lower today. One that I'd like to highlight would be GE Aerospace, which also dropped today after voicing cautious commentary on the Iran war, despite having really strong results.
Talk to me about Tractor Supply. What do they do?
Yeah, Tractor Supply offers everything from food for horses to foods for your dogs. They actually dropped nearly 12% for their biggest one-day drop since 2022. That's after the company reported first quarter comparable sales that missed estimates. The company said that while the performance was generally positive, shoppers spent much less on pet supplies like dog treats and chew toys. And Truist writing in a great note that growing competition from Walmart, Amazon, and Lowe's is causing a lot of pressure for them and may also be responsible for that drop in sales.
All right, we will leave it there. Bloomberg's Avalon Purnell, thanks for joining us. Coming up next, market reaction and stock picks in tech and financials. Back in a moment. As the markets keep a watchful eye on the Iran-U.S. ceasefire set to expire tomorrow, my next guest says the bottom for equities is already in and is now bullish on tech and financials. Let's go to Whitney Stewart, client portfolio manager at Sterling Capital Management. Whitney, thanks for joining us today.
Yes, thanks for having me.
You see investor sentiment shifting away from the conflict in Iran. Where are they focused?
Yes, so we think investors are moving away from the Iran conflict, the price of oil spiking, causing inflation fears, and now shifting their focus towards this coming earnings season and beyond, AI and the Fed. And we think those are the big macro drivers going forward.
You also think equities have seen their lowest point. What leads you to believe that?
Yes, so since the bottom, essentially March 30th, you've seen the NASDAQ had a 13-day winning streak in a row. S&P 500 all-time highs last week, NASDAQ all-time highs last week, and potentially this week. Historically, when you get those type of V-shaped recoveries, they're generally implying a bottom is already in. Obviously, anything could happen in the future here, but it does look like the market is signaling the bottom is in for the concern around Iran conflict and oil. And again, now shifting focus towards this coming earnings season, specifically around some of the key sectors that may have a beat and raise setup with lower prices, we think could be attractive opportunities for investors.
That being said, do you think boots on the ground situation in Iran or in the Middle East could change your thinking of the market having already bottomed out?
It's possible, if the war were to escalate and the price of oil were to go back up to near all-time highs. Again, if the Strait of Hormuz were to stay closed for an extended period of time, you may see the same trade where energy outperforms most other sectors, and then anything that's risk-on associated, think like technologies, financials, they may go down again. But it looks like that the market is signaling that it's moving on from that correction and focused on the future. So again, you would need an acceleration of concern associated with the war in oil. Right now, it looks like the U.S. administration is heavily motivated to de-escalate, as you do have upcoming midterm elections here later this year.
Okay, so let's talk about earnings, which you say investors are now pivoting and looking towards. Do you think energy prices will be the big overhang there? We know United will be reporting, and we expect that to be something that pops up for them.
So yes, for the airlines, it's a big issue. They've already mentioned Alaska. Mentioned earlier today, the price of oil or jet fuel has essentially crushed their margins here in Q1 and likely in Q2. And so that's going to be an overhang on that specific sector. Consumer sectors not seeing as much overhang as you might think. That so far the expectations are still decent earnings there. Technology and financials almost very limited impact in those sectors, and those are two of the biggest sectors. And they also have they were two of the worst performing sectors. So, we think about tech and financials as having a pretty attractive setup fundamentally, with earnings expected for tech to be up over 30%, financials expected to see 15% growth, and the stocks are still down from previous highs.
So you like small caps as well right now. Tell me about that.
Yes, so the Russell 2000 index is actually up, over 10%, outperforming the S&P 500, outperforming the NASDAQ, which has not been the case, for many years. So we think small caps are pretty interesting, and it's an area where you may be able to play larger cap themes and simply have lower valuations. So for example, we believe EnerSys is fundamentally well positioned, and essentially it's a battery solutions company. So think batteries for data centers. That business is growing 28%. They're also supplying batteries for drones and military applications. As you would expect, that business is also improving pretty dramatically. And so it's got that same high-level theme of data centers require a lot of power and a lot of electricity, and data center build-out is expanding rapidly. And therefore, this company is benefiting. And then also drone activity and military applications also accelerating. But you're not having to pay the same valuations when you go down cap with EnerSys.
Okay, I don't want to get to one of your other top picks here, or stock picks, which is American Express. We've seen Visa and American Express, not as much, but MasterCard as well, sort of going sideways for a while. What do you like about American Express?
Again, we think the American Express fundamentally is well positioned on the go forward here. The stock, did move lower with the price of oil going up, as some investors make the leap that price of oil and gasoline goes up, then therefore consumers are going to spend less. American Express specifically is geared to the higher income consumer, as well as business travel and business expenses, which tend to be less reliant on gasoline prices or jet fuel prices. And so historically, the stock tends to generate pretty good earnings even after a spike in the price of oil. So we like that setup. And additionally, we're expecting the earnings to be pretty solid, over 10%, double-digit, consistent earner. The company also has a track record of raising its dividend year over year, quarter over quarter, and reducing the share count. So since 2022, they've reduced the share count by 7%. Lastly, the return on equity is over 30%. So we think fundamentally the company's really well positioned, and we think the concerns around Iran and oil are probably a little overstated if you look forward 1, 2, or 3 years in the future.
Let me get you quickly on Microsoft as well. Investment in the big Mag 7 has sort of reignited. But why do you like Microsoft from the group?
Yes, Microsoft, we also think is well positioned. It is part of the Mag 7. A couple of weeks ago, some people were calling it the Lag 7, as was underperforming pretty dramatically before this recent rally. Microsoft's still down year to date, still down from the highs. It's one of 2 AAA balance sheet companies in the world. So it's one of the best balance sheets in the world, $90 billion in cash, excellent management team, seasoned management team. More importantly, a lot of these tech stocks are really focused on AI. Microsoft's narrative has been a little bit negative, assuming that it's only partnered with OpenAI or ChatGPT. What they've recently done is actually open up the platform. So it's not just OpenAI. There's also Anthropic's Claude. There's also Mistral, Perplexity, other AI solutions. In other words, Microsoft is pivoting to becoming more of a marketplace like Apple's App Store, where they don't really care which one of their enterprises uses which AI service or solution. They just want to use Microsoft. Microsoft wants their customers to use Microsoft's cloud, Azure, which is growing 38%. So we think Microsoft is well positioned to actually be an AI beneficiary, and the market may be a little too focused on the short term, and long term, we think Microsoft is going to benefit from AI.
Yeah, interesting way it is positioning itself. Whitney Stewart, I got to leave it there, sir. Thanks for your time.
Thank you.
And United Airlines, we did tell you they are reporting. Here are the numbers coming in for their first quarter. They're slashing their full year profit forecast, of course, because of the higher fuel prices biting into their bottom line with what is going on in Iran. United Air shares down in after hours over 1% as they take that adjustment. They now expect their full year adjusted earnings to be $7 to $11 a share. Initially, it was in a range of 12 to 14, so an adjustment down there. First quarter adjusted earnings were $1.19 a share. That did beat the estimate of $1.09. Revenue rose 10.6% to $14.6 billion, and that did beat expectations of $14.5 billion. For the second quarter, United projected earnings of $1 to $2 per share based on an all-in fuel price of about $4.30 a gallon. Fuel expenses climbed 12.6% in the first quarter to $3.04 billion, up roughly $340 million from a year before. And remember, that ceasefire deadline for the U.S. and Iran is tomorrow. It's unclear what happens next, whether that ceasefire gets extended, whether there will be boots on the ground for the Middle East, for the U.S., and then what will happen with oil prices. Of course, all of the airlines and travel companies watching that. Up next, we'll look into Amazon expanding its partnership with AI company Anthropic. That's after the break. The race to build out AI infrastructure continues with Amazon's expanded partnership with Anthropic. Amazon Web plans to invest up to $25 billion U.S. in Anthropic. And in turn, the AI company has committed to spending over $100 billion on AWS over 10 years. Let's go to Ronald Josie on the senior analyst, Internet Equity Research at Citi. Thanks for joining us today.
Great. Thanks for having me.
So we're seeing, again, a lot of this circular investment strategy. Is it risky?
Well, I'll tell you what appears to be very much true. It's that the demand for enterprise compute doesn't seem to be abating anytime soon. We use the word insatiable. We just got back from our City AI Summit last week, and what we heard over and over again was just that demand from the enterprise continues to grow on adopting AI tools and technology. And the news yesterday where Anthropic is dedicating additional at least $100 billion in spend over the next 10 years, in exchange for additional compute capacity. This is on top of their Amazon's Open AI partnership announced in early March for an incremental $100 billion. You know, it seems to me that demand is accelerating at a speed and pace that I think Amazon and others are trying to keep up.
Okay, lay it out a little bit more for me for these two companies. So AWS will supply Anthropic with gigawatts for training the Claude reiteration, which will use AWS's Trainium AI chips, which have yet, I think, to be debuted. But can you lay that out a little bit more for me?
Sure. So as part of the deal, Anthropic is already a very large partner of AWS. In 3Q of last year, Anthropic and AWS launched a dedicated data center, dedicated data center campus of about 30 buildings. 7 were live, soon to be 30, of about 500,000 of these Trainium 2 chips to basically train and run through inference Anthropic's models. That launched in fall of the August-September timeframe. That full-on Trainium data Project Rainier data center should account for about 2.2 gigawatts of compute power and likely fully comes online at the end of this year. Trying to sort of take a step back, this in our mind was a key step to Anthropic seeing basically helping to answer the incremental demand from the enterprise side. Now, what we heard yesterday was an incremental $100 billion of spend, a total or up to 5 gigawatts of compute power, in addition to a new investment in Anthropic by AWS. So point being is, trying to lay it all out, Amazon built a specific data center cluster of about 30 different buildings for Anthropic. That came online, some of it at least in the latter half of last year, continues to ramp, continues to drive more capacity. That's in turn delivering greater demand to Anthropic. And frankly, I think Anthropic saw the demand, and for that reason, they're signing up for even greater compute.
Yeah, it is so hard to wrap your head around the build out without physically seeing how big it is. You say 30 buildings and you're like, okay, I can't even imagine that. Amazon will report earnings next week. What are you looking for?
Yeah, I mean, look, we're looking for everything we just talked about in terms of AWS growth. We're looking for 28% growth in AWS year over year. That would be an acceleration from 4Q's 24%. And frankly, that actually might be low given all of the news flow that we're hearing. So we actually think AWS demand is very strong. Meanwhile, the mix shift for Amazon's retail business to essentials, as well as groceries and perishables, we think can drive overall retail growth of, call it high singles, low double-digit growth. You put that together, and we actually think it'd be, we should see increasing profitability here from an OI perspective. One of the things that we'll be looking for, though, is insights, not only just on AWS, of course, as well as their partnerships with OpenAI and Anthropic, but specifically we'll be looking for insights on their Project Leo, or their LEO, which is their low Earth orbit satellite system, used to be called Project Kuiper, that's expected to launch here in the middle of the year. Point being is there's a lot going on at Amazon. We actually think the demand side on AWS as well as retail is holding up very well. And so now the focus is on profitability, at least in the short term, until we can start seeing, returns for some of these investments they're making, either it be Leo or same hour, same day delivery and things along those lines.
Okay, so that was a Global Star acquisition you were talking about that will help the satellite build out for them. I also realized today that Amazon in the U.S. is essentially a medical provider as well. They can hook you up with a doctor in your area, and they can provide you pharmacy services to your door. How big of a part of the company is it? Do you see expansion for them there? I mean, basically, they're getting their hands in a lot of different pies.
Getting their hands in a lot of different pies. I don't know if, at least in the States, I believe their logo is Amazon from A to Z with the smile. And so it's a little bit of everything. They acquired a company called One Medical several years ago that is helping to do this healthcare. And there is absolutely a trend in overall globally, certainly here in the U.S., towards wellness. And so Amazon is building out their One Medical suite of tools, as well as their health suite of tools for improving wellness. And so you saw the news flow today, and I would imagine you're going to see more of that going forward as we Prime members, as more Prime members rely on Amazon for not just delivery, but for all sorts of goods, including video and, healthcare and others.
Yeah, the news today was, of course, they're getting in on the obesity drug part of the business and are going to start delivering those to people's homes as well. Ronald, thanks for joining us. Good to talk to you, sir. Thanks for your time.
Thanks for having me.
Coming up next, viral Chinese EV videos fueling envy for cars Americans can't own. More in a moment. Here are the stories making headlines today. Kevin Warsh faced Congress for his confirmation hearing to replace Jerome Powell as chair of the U.S. Fed. Lawmakers focused on Fed independence after Donald Trump said he'd only appoint a chair willing to lower interest rates. One American senator pressed Warsh on the independence during the hearing.
Do you suspect that he chose you because you indicated to him that you want to cut rates?
Senator, I don't know the reason for the president's choice, but I can tell you what I've been writing about for 15 years and what I said to the president, which is
you're going to I'll cut rates if you give me the job.
No, that's not what I said, Senator. Now, the president, as you might know, much like virtually all presidents I've either known or studied, presidents tend to be for cutting rates. I think the difference is President Trump expresses it quite publicly, without surrogates or subterfuge, but presidents want lower rates. But Fed independence is up to the Fed.
The Globe and Mail is reporting the federal government leaning towards a southern pipeline route to bring oil from Alberta to British Columbia. According to the report, the route could end up at the Port of Vancouver. It could also face fewer environmental hurdles and less resistance from Indigenous groups. According to one source, Alberta expects Ottawa to designate the pipeline a project of national importance in the fall. Ottawa's launched a new advisory committee on Canada-U.S. economic relations. That group will help prepare for the joint review of CUSMA later this year, the goal of maintaining and building on that existing framework. Several high-profile names are on the committee, including Aaron O'Toole, Lisa Raitt, and Flavia Volpe. The advisory committee is scheduled to hold its first meeting later this month. Although Chinese car brands are virtually non-existent on North American roads, that hasn't kept them from breaking through online, showing inflation-wary consumers what they're missing. Bloomberg's Gabrielle Coppola has more.
These videos are all over the internet.
This is what $37,000 gets you in China, and I promise you are not ready.
On YouTube, Instagram, and TikTok, American car influencers are hawking Chinese car brands.
If you're a rich mom in China, you're probably driving this. This is the Yangwang U8.
They're touting luxury features.
Everything massages you.
State-of-the-art tech.
Hey, I'm astonished.
And most importantly, low prices.
All of this for $15,000.
But inflation-weary Americans watching these videos can't import the cars. Let's go back a bit. For decades, the global auto industry was really ruled by basically the US, Europe, Japan, and Korea. Then China decided to get into the car business. The Chinese government forced Western automakers or non-Chinese automakers to form joint ventures with state-owned Chinese companies. At first, they weren't very good at it because they were still new. At some point, Chinese automakers realized they were never going to beat them at gas cars, so they decided to play a different game. And the Chinese government created a national goal to develop electric vehicle technology.
我们想做的是真正从底层逻辑上改变大家对新能源车的看法。
And a lot of Chinese entrepreneurs answered that call, like BYD, which started out as a battery company and then got into automotive. You also have Geely, where the founder Li Shufu started making parts for refrigerators. Xiaomi, they're a cell phone company that has now gotten into cars because cars are becoming really software driven.
Today we're at the headquarters of Caresoft Global at our new technical center. We have many vehicles that we have disassembled and done value analysis. We've done benchmarking work on. Here we have a Tesla Model Y, and it demonstrates their usage of mega castings. In doing that, they're able to reduce the mass, reduce the number of parts, reduce the labor and the time it takes to build the vehicle. So very innovative approach. Now we see from China, the Xiaoping G6. They've come forward with a very nice vehicle, and if you look close, you find there is a mega casting in the rear. There is a mega casting in the front. There is no floor in the body. It's very, very similar. It's been imitated here. However, if you look closely and study it, you realize they've been improved upon. And we see that across the Chinese auto industry, brand by brand. This drive to imitate, to improve, to increase, and to do it very, very quickly. And we're reminded, it's not the big that eats the small. It's the fast that eat the slow. So when you look at the speed of the Chinese auto industry, I think the traditional OEMs, those from North America, those from Europe, they get it, they understand. This cannot be left unchecked.
Car companies in the United States definitely need to worry about Chinese cars, and they are worried about Chinese cars. Even though it's basically impossible to sell them in the United States today,
the reason is a combination of tariffs and regulation that's linked to national security. In 2024, under President Biden, the United States introduced a 100% tariff on Chinese EV exports. In addition to that, in early 2025, a new rule was introduced, which essentially banned the sale and import of vehicles containing technology linked to China. This in practice makes it very, very difficult for Chinese companies to import into the United States.
Even though the US has these policies in place to keep Chinese cars out, they're growing almost everywhere else in the world. They have a lot of market share in Mexico, they're growing in Brazil, they're taking over Europe, they're big in Southeast Asia. Think of it as a global pie that's a finite size. And so when the Chinese come in and take share, that means another automaker like Toyota or Ford or Volkswagen is losing share. Just like we're seeing the growth of physical EV exports from China, viewers in the US on social media are also seeing them more. Last December, YouTuber Marquez Brownlee posted a review of the Xiaomi SU7, and he was really impressed with it.
There is basically no question in my mind that if a car like this was available in the US for $42,000, that it would crush.
The review went viral with over 10 million views. It really woke Americans up to just how sophisticated Chinese cars have become. China's entry into the global auto market is very controversial because it's threatening the future of a lot of existing companies. There's really dueling narratives about what's going on. If you talk to people in the US or in the West, they'll say that China is not playing fair, that they're getting support from the government. But one thing I noticed on TikTok is that there's a really different narrative there. And what you see is that the story is more it's the US who's being unfair and hypocritical by not letting American people buy them.
While lurking on Red Note, I found out about this car. We can't sell this car because it's Chinese.
I think when people on social media see Chinese cars, not only are they so impressed with the technology and the price, they're also really mad because cars have become really unaffordable in the United States. The average new car price in the US is around $50,000. That's just out of reach for more and more people, especially now with inflation and high interest rates. Everyone talks about how quickly China is moving. They can design, develop, and produce a new car in 18 months versus 3 to 5 years for a Western car company. And that brings up questions of quality and reliability. But the truth is we don't know yet because EVs are still a relatively new technology. Even though there may be some questions in consumers' minds, that doesn't mean that the legacy automakers aren't looking to China to learn how to make cars like they do.
What you're seeing right now is actually a lot of big European automakers engaging with Chinese technology very openly. US companies have been very hesitant, and it's been very difficult for them to do the same. So it's a really difficult balance to get right. I think the future of the US automotive industry really hinges on the question of whether or not there's going to be more openness to Chinese technology. It might mean more openness to maybe licensing some Chinese technologies. These kinds of arrangements, if done carefully, could be a real boon for the US industry. It could allow for more innovation.
Even though the US has been successful so far in keeping Chinese cars physically out of the country, they can't control what people see or what people think. The Chinese cars are very hard to resist for a lot of people, and I think that puts pressure not just on US politicians, but also the rest of the auto industry to have more affordable cars that are as good as the Chinese, or else people are just eventually going to vote with their wallets.
Coming up next, an insider's optimism about a trade agreement between Canada and the US. We do want to share some breaking news with you. The ceasefire between the U.S. and Iran was set to expire tomorrow. Now the U.S. president says he will extend it to give Iran more time to come up with a plan for a permanent end to the conflict. For how long? That's not yet been made clear. It looks like the U.S. blockade of the Strait of Hormuz will stay put, at least for now. Let's get to this. Ontario's representative to the U.S., David Patterson says he's confident an agreement to resolve trade frictions between Canada and the U.S. is possible this year. Let's go to Bloomberg's Toronto bureau chief, Melissa Shin. She joins us with more on that. Melissa, why do you think he's so optimistic about this? Not everyone is.
Fair enough. One element he pointed to is the pressure from American businesses, which are seeing higher costs as a result from tariffs. And so especially the auto sector as well. It's still very reliant on cross-border supply chains. We've been hearing about this a lot, sort of cars going back and forth, et cetera. And Canada is still the largest export market for U.S.-made cars and trucks. David Patterson said it would be the equivalent of closing down 4 full auto plants and 7 times that in parts if we denied the U.S. access to the Canadian market. So, that's a pretty big impact, and he's hoping that, cooler heads will prevail on that front. He also pointed out that the midterms are coming up. There's a lot of cost of living concerns that the U.S. Electorate is facing with the war and, of course, tariffs and other things. He said a deal will be the biggest lift in the American economy that you could possibly come up with before the midterms, and for him that's a compelling reason that the U.S. president would consider doing this deal. And finally, he also points out that that everybody knows what the issues are. The Canadian policymakers know, and the U.S. has been very clear about what their concerns are.
We've heard very recently this week that Mexico is further ahead in negotiations than Canada is. We've heard this line before. Why do you think that is?
Yeah. So what David Patterson said was that, this is actually not a point of worry for Canadians. He said Mexico has a much harder list of negotiating topics. So just as I mentioned that, Canada knows what the U.S. is concerned about, for example, dairy, digital taxes. The things that are concerning regarding Mexico, according to him, are things like cartels, border porousness, things that really are big issues that can't be resolved through negotiation alone, and so therefore his view seems to be that if there are such big issues to tackle, it's important to do that sooner rather than later. So Mexico is beginning its bilateral negotiating round with the U.S. the week of May 25th. We don't have a date yet for Canada.
Okay. Let's talk about the fact that Canada and Ottawa has been moving closer to try and solidify more of a relationship with China because of the problems we've had with the U.S. So why does he trust U.S. over China?
David Patterson trusts the U.S. over China because, he feels that right now we need to separate the signal from the noise. And he said, a lot of how people here view, sort of the relationship is through the lens of specifically what Donald Trump says. And, obviously there's been a lot of comments and bluster. And so therefore, it sort of creates a feeling that there's a lot of negativity. But his view is that because the two countries, Canada and the U.S., are, as he called it, geographically hooked together, and there's such a long relationship, the aforementioned supply chain connections as well. We supply a lot of oil to the U.S. There's a lot of pre-existing economic reasons that will continue long before and after, whoever is the president. And so, he really does feel that the U.S. is a reliable partner, and that when the chips are down, they will be there to protect us.
I guess we'll see about that. Bloomberg's Melissa Shin, thanks for the update.
Thank you.
So on that note, the prime minister, with the concern about this deal and how difficult it could be to get to an understanding with the U.S., Mark Carney's announced the creation of a new advisory committee on Canada-U.S. economic relations. They will serve as a forum for expertise and strategy on all aspects of the relationship between the two nations. CTV's Mike LeCouture has more.
As the cross-border tensions ramp up in the playoffs, the Prime Minister is assembling his own team to enter the trade arena with the U.S.
I'm very pleased to have that group. It's a diverse group, leaders from the union movement, experts in industry.
Carney's reconstituted Canada-U.S. Advisory Committee brings together 24 CEOs, former politicians, and business leaders. Holdovers from the previous version include Unifor President Lana Payne, former Quebec Premier Jean Charest, and Flavio Volpe, President of the Automotive Parts Manufacturers Association. Now, there are plenty of new faces, including former Conservative leader Erin O'Toole, the President of the Aluminum Association of Canada Jean Simard, and the head of the Canadian Chamber of Commerce.
We can't forget about our small and medium enterprise businesses. That's 98% of our businesses. And so I look forward to sharing that perspective as part of the committee.
Hearing from people impacted by the Canada-U.S. trade war is key, according to the committee's chair.
I think it'll help our negotiations and it'll help the government of Canada be informed in terms of these different perspectives.
Conservative leader Pierre Poilievre didn't criticize the committee, but he did take aim at the lack of progress in the negotiations.
He's done absolutely nothing on this file in the last year other than use it to stoke fear and distract from his catastrophic failings here at home.
So how far behind is Canada in negotiations? Well, U.S. Trade Representative Jamieson Greer is meeting with his Mexican counterpart to discuss CUSMA at the end of May. There are no such meetings scheduled for Canada and the U.S. Mike LeCouture, CTV News, Ottawa.
When we come back, United Health reporting earnings. We'll dig into that in just a moment. American insurer giant United Health has delivered stronger than expected first quarter results and raised its outlook, signaling progress in a turnaround aimed at tighter cost control and a leaner operation. For more, we were joined by Lance Wilkes, managing director and senior equity analyst at Bernstein.
The first has been an industry cycle, and that had to do with, particularly in the Medicare Advantage business, as costs were really high, rates were low, and the most important thing, pricing discipline among the various players, United, CVS, Humana, was weak. And so that allowed them to kind of continue to maintain their share, but really erode their margin. That was the biggest driver. United also had a change in management as a result of really, I think, some weak recognition of some of the challenges they were facing. And that elongated the problems that United had relative to some of those other players. So the other players, I think, confronted their challenges in 25, where United let those extend into, in 24, United let those extend into 2025.
And Medicare Advantage it provides benefits similar to the original Medicare, but through a private company.
Yeah, that's right. The way it works is the government has a traditional Medicare program, and they set a pretty low price for most units, and then they reimburse at that price, and the consumer pays 20%. Medicare Advantage, they get to use the government's price because they're an agent for the government. But then from there, what they do is they employ managed care techniques to try to steer people to lower cost settings, to try to stabilize individuals in some treatment programs. And then the savings typically kind of get rolled back into the program in the form of extra benefits for the senior. Each year that lures more seniors into that program. Today we're about half of the seniors in the US that are in the Medicare Advantage program.
And is it profitable generally for the health insurers, Medicare Advantage?
Yeah, great question. So in recent years of 2016, 2022, this has been about a 3% profit margin business. The government while savings presumably from this program relative to the traditional program might be more like 18% or more, the government caps profitability for the private players here and makes those savings get passed along to the customer. That 3% has eroded, so the industry is probably generating -1% to -50 basis point margins over the last 2 years.
There's been massive executive changes at United Health. Something like half of the 100 company's top 100 leaders have been replaced. Was there a management problem?
Yeah, I think there really was. And I think the most important thing, again, my background, I've been an analyst for 10 years, but 20 years in industry. And when you're in the insurance industry, pricing discipline is really the key thing. You're always trying to decide how much do I want to grow versus how much do I want to maintain my margins. And I think United and others really got swept away with a focus on growth, and that becomes a cultural issue. And with a change in CEO and then a change in talent throughout the organization, what they're really redoing is resetting that balance so that they're capturing much more of a focus on margin, and then they'll try to moderate it and get it somewhere in the middle there.
Are they a target in Congress from time to time? People, obviously, soaring health costs are always an issue.
Yeah, I think United, being the largest player, is a unique sort of target. And there are a number of topics, whether it comes to vertical integration or other things, that United maybe wasn't as adept at dealing with policymakers about, and presumably the new CEO, who's a former CEO, maybe a little better at that. I think in addition, one of the big industry problems was the industry was incentivized to find codes for, having sicker patients, and you get paid more for a sicker patient. And they did too good of a job of it. Effectively, they were getting overpaid about 10% in 2023. The government has cut back on that, which is part of the pressure on the industry. Today, it's about 4% overpayment. Next year, it'll be down in the 2s. And over time, probably in another year or two, that'll be down to 0% relative to kind of the traditional program.
Thank you very much, Lance. Really appreciate it. And sorry, Lance, I forgot to ask you, would you be a buyer of UNH right now with fresh money?
Yeah. This would be my top pick. This is the beginning of an insurance cyclical recovery. I think first quarter the stock was down 18%. Second quarter to date, we're up about 25%. And my price target's significantly higher than we're at right now. And I think this is a multi-year recovery before you get back to target margins. And so I have conviction in that. Yes.
Lance Wilkes is managing director and senior equity analyst at Bernstein. A final look at how we ended the trading day today. Dismal one for the TSX, which dropped 551 points or 1.6% on the day. The S&P down 45 points or 0.6%, and the Nasdaq down 0.6% as well. a drop of 144 points. That does it for the close. Thanks for joining us. See you tomorrow.